part one. We will look at sales contracts and what elements need to be present in order for it to be Sharia compliant. We will look at an example of a sales transaction and how it's permissible for the participants to agree a sale price that can have reference to something, in this case, how many days it's rained in the last 10 days. We will take a look at what LIBOR means and how it's used in the financial markets. So when we consider benchmarking to LIBOR, first of all, let's discuss the context in which this happens. This happens in sale contracts. Right, so the item must be halal. So here we're talking about what's acceptable in Islamic law, okay, and specifically in Islamic commercial law. Right, so this is the area where sales contracts are part of. So now we're going to discuss, the essential elements of a sale contract that must be in place for the sale contract to be halal. So first of all, the item must be halal. So in simple terms, things like wine cannot be bought or sold, drugs, really any asset that's not Sharia compliant. So even if you meet the other aspects of a contract which we'll talk about, but any transaction involving them cannot be halal. Okay, so the underlying goods need to be halal. So the goods must be clearly defined. Okay, and there's a very good reasons for this. So what we mean by the goods must be defined. So if there's a certain amount, like how many are you buying, or if there's a weight, you must have a clear description of the items, the size, the color. So if there's anything that is actually important for the definition of the sale of the goods involved, right? If it's important to the nature of the item, if it's important to the contract, then it must be clarified in the contract. Without this, it is problematic that we can introduce an element of risk into a contract if it is not strongly defined enough in these characteristics of an item in a contract of sale. So this avoids gharar. Okay, so gharar is it's a type of uncertainty. Okay, so which impacts the equitable execution of the contract. So here we're talking about the goods. So there are many ways which gharar could be introduced into a contract, but here we're looking at the goods. So if these goods are, for example, not well defined according to these characteristics, then that leaves the possibility of failure of an equitable execution of the contract. It could mean that one party could be taken advantage of, either deliberately or not deliberately, but it means the contract it has not come up to the standard required, and if the deficiency, if the gharar is major, then that can actually make the contract void. Okay, so one of the issues now we come to sale price. So the parties can agree any price. This implies that there's a free market and an open market in place. So the parties can agree whatever price that they like, and the assumption is that there's no coercion, no duress, that the one party is not putting pressure or forcing the other party to purchase at a certain price. Okay, so a free agreement of any price. This is all part of the requirements of a sale contract to be Sharia compliant. And one important point, you can pay now or in the future. So let's say we have a sale contract between two parties, and the goods are being sold this way. And then let's say we have the price being paid here in pounds, and there's some flexibility in this price. You can pay it now, so then it is a spot sale. The goods are being exchanged at the same time as the money, or you can pay the price in the future. So this is still seen as a spot sale, but the payment of the price is in the future. It does not make it into a future transaction, a future sales transaction. It does not. Okay, so you have the choice to pay the money now or pay the money later. But so there's one big assumption we're making here. The assumption we're making about the goods. The goods must be delivered now. Okay. Okay, if you have flexibility about the cash being paid now in the future, the goods must be delivered now. There are a couple of exceptions. Okay, but I'm not going to discuss them here. So the exceptions relate to a salam sale, for example, where the goods can be delivered later under certain circumstances. But these are the exceptions to the standard contract, where the goods are expected to be delivered now and the cash can be paid either now or in the future. Okay, so now let's talk a bit about the price that's being agreed. So any price can be agreed, as we've discussed. So that means, can we use any reference point for the price? So in theory, as long as the two parties agree, you can use a reference point. So let's discuss what this means when you use a reference point. Okay. Okay, so we have the regular sale. The goods going this way and the cash going this way. So let's say that they're struggling to agree a sale price and they want to agree a reference point. So they can, in theory, they can. So in theory, for example, let's take it to one extreme. They can say, let's look in the last 10 days. Let's look at the weather that's occurred, right? And let's say for each day that there's been rain, let's multiply that by £10, and that's the price. So this has already occurred, right? So they can say, now look at the history of the weather, and let's say there's been 4 days of rain. So they can say that this makes the sale price now £40. If they wanted to do this, in theory they can, because they're both agreeing the price. There's no coercion. There's open agreement between the price. So once they've agreed the price, then the sale contract takes place after that. Right? So the sale contract itself shouldn't make reference to anything that's uncertain. It shouldn't make reference to, how many days it's rained in the past. It doesn't need to, because that can create some uncertainty. It certainly should not include any reference to how many days it might rain in the future. Right? That's not permissible in general. So if you refer to, in a conversation, they can refer to how many days it's rained in the past. They can say it's rained 4 days, that means £40. And then when they create the contract, they will say the sale price is £40. So it means that they've had a reference to the benchmark. The benchmark in this case is how many days does it rain in the last 10 days. So in theory, this is permissible because both the parties are agreeing and there's no coercion. And at the time of the sale contract, the price is specific and it's clear. Okay. So now we come to the main point of this discussion, which is, can we use LIBOR? So first of all, let's explain what LIBOR is. So LIBOR stands for the London Interbank Offer Rate, or offered rate. So obviously, so we take the first few letters and it's LIBOR. So this is what it is. So this, so let's have a definition from Investopedia. Okay, so this is from Investopedia. What is LIBOR? It says a benchmark interest rate. That's the first thing to note, right? It's an interest rate which major global banks lend to one another, international interbank market. It stands for London Interbank Offered Rate, which you've said. It's a globally accepted key benchmark interest rate that indicates borrowing costs between banks. It's calculated and published by the ICE exchange. Okay, so it's an interest rate and it's a benchmark that's set by the interest rate markets. So that's clear. So what is LIBOR used for? Again, let's take a look from a major reference. I think on the same website, on the Investopedia website, they do explain some situations of where it's used. Okay, so here we can see some uses of LIBOR. So we have some financial agreements like forward rate agreements, interest rate swaps, interest rate futures, and swaptions or options. And we have commercial products now. So this is where this is used in Islamic banking. So certificates for deposits and notes, variable rate mortgages, right? This is where we see it very often. Syndicated loans. So this is a huge market in Islamic banking. Loans are offered by a group of lenders. We have CDO, CMO, callable notes. And here we have another area that's very popular for Islamic banking. So these two are the most popular areas. And this one is consumer loan related products. like individual mortgages, student loans, and personal loans, for example. So I would say these two areas are the ones where Islamic banks tend to use it most, especially in the retail banking area. And conventional banks, of course. I mean, conventional banks, this is standard that they use it. So here we're talking about what we will go on to is the situations in which Islamic banks use LIBOR. In part 2, we will look at some of the rates that are used globally in the financial markets, like LIBOR and other alternative rates as well. And we will begin to talk about what it means to benchmark a sale price to LIBOR. We will go through an example which explains clearly how an Islamic bank uses LIBOR to benchmark its profit rate in a sale transaction.